Look, right now, everyone online is trying to sell you some secret wealth building strategy. It's completely overwhelming, right? Well, I spent the last few months deeply investigating 8 of the most popular wealth building methods out there. My goal? To finally separate what actually works from what's just overhyped internet noise. So let's get right into this. Because here's the honest truth. Just working hard, it's never going to make you wealthy on its own. That's a strategy problem, not an income problem. So which of these heavily promoted, flashy strategies actually build real long-term wealth? Well, to figure that out, I rated every popular method. I looked at the actual effort required, the realistic income you could expect, and the long-term sustainability. We are literally going to separate the noise from the signal once and for all.
Here's our agenda for this investigation. We'll start with the wealth-building illusion, move into the shiny object traps, and then look at the psychology of losing. After that, we'll break down the 3 proven wealth engines, look at the math of compounding, and finish up with why true wealth is unseen.
Section 1. The Wealth-Building Illusion.
Let's kick things off by breaking down 5 methods that sound super appealing online, but usually completely fail the average person. First, dropshipping. These stores mostly fail within 6 months because the margins are just razor thin. Then there's crypto speculation, which literally relies entirely on a greater fool eventually buying your tokens. What about day trading? It just drains your accounts through fees and bad market timing. Car flipping is another popular one, but honestly, it requires immense mechanical skill and time that most of us just don't have. And finally, permanent side hustles. These usually just become exhausting second jobs with extremely low upside. The math simply doesn't work out.
Section 2. The Shiny Object Traps.
So why do smart people fall for these traps? Well, look at person A here. They suffer from what we call shiny object syndrome. They're randomly jumping from drop shipping to crypto to day trading, always chasing the next big thing. Fast forward 10 years, their net worth is basically zero. Now, contrast that with person B. Person B is, well, kind of boring. They commit to building actual skills, automating their investments, and just being patient. But look at the result. Over that exact same decade, person B quietly builds a $200,000 net worth. It just goes to show you, strategy matters so much more than luck.
Section 3. The Psychology of Losing.
You know, to really understand why we lose, we have to talk about Abraham Wald's famous bomber plane realization. It perfectly explains survivorship bias in investing. During World War II, Wald pointed out that the military was only analyzing the damage on the planes that actually survived and came back. The ones hit in the most critical spots, they never made it home to be counted. It's the exact same thing in finance. We only ever hear the loud, flashy stories from the 1% who got incredibly lucky on a crypto coin or a perfectly timed trade. The quiet majority, the ones who lost absolutely everything using those exact same methods, they completely disappear from the narrative. And there's another massive psychological trap we fall into, called the disposition effect. Basically, this is our hardwired tendency to sell our winning investments way too early, while stubbornly holding on to our losing investments, just hoping they'll miraculously bounce back. It's crazy, but our own emotions literally push us to make terrible decisions. Decisions that just cement our losses and generate totally unnecessary taxes. And the data totally backs up this psychological drag. Research clearly shows that hyperactive day traders earn an average annual return of 11.4%. But meanwhile, passive buy and hold investors, they're earning 18.5%. Constant activity might feel rewarding, but it's patience that actually pays the bills. Now, before we move on, if you're finding this valuable, please subscribe to WealthLab and share this explainer with your friends and family. It really helps us grow.
Section 4. 3 Proven Wealth Engines.
Okay, so if all that other stuff fails, what actually works? Out of all 8 methods we investigated, only 3 have a genuinely strong track record for ordinary people. The absolute core engine here is low-cost index fund investing. Once you build up some capital there, the other 2 reliable methods are real estate held for the long term and dividend investing. This 3-pronged approach, yeah, it's pretty unsexy, but it genuinely works.
Section 5. The Math of Compounding. And really, the common thread between those 3 winning methods we just talked about comes down to 3 basic things: time, consistency, and avoiding unnecessary risk.
When we look at foundational retirement models, like the traditional 4% rule, they aren't based on luck. They are anchored entirely in mathematical reality. Broad market portfolios compound predictably over decades. You don't need to find some magical, once-in-a-lifetime trade. You literally just need consistency over a long time horizon to avoid that unnecessary risk.
Think about it like this. By owning a piece of the entire economy through index funds, you harness long-term historical returns. Historically, U.S. stocks have averaged a 10.37% annual return. You get to capture all of that economic growth without taking on the massive risk of trying to pick individual winning companies or trying to time the market perfectly.
Here is the absolute magic of compounding right in front of you. If you invest just $500 a month at a conservative 7 to 10% return, that grows to somewhere between $560,000 and over $1 million in 30 years. And the craziest part? The vast majority of that eventual wealth doesn't even come from your hard work. It comes from your earlier returns producing brand new returns. It's like a snowball rolling down a hill.
Section 6. True wealth is unseen.
So how do you actually choose your path moving forward? Well, you have to look at those 3 proven methods and decide which one fits your specific income, your available time, and your personal risk tolerance. But more importantly, you have to completely redefine what success looks like. The book The Psychology of Money points out a really hard truth. When you see someone driving a $200,000 Ferrari, the only thing you actually know for sure is that they now have $200,000 less than they did before. Spending money to show people how much money you have is quite literally the fastest way to have less money.
Because true wealth, it isn't the highly visible spending used to impress strangers on the internet. Wealth is the cars not purchased. It's the diamonds not bought. It's the assets compounding quietly in the background while you sleep. True wealth is simply the invisible, unspent financial assets that ultimately provides you with permanent options and total freedom.
Look, 5 years are going to pass whether your financial strategy is incredibly exciting or incredibly boring. So you really have to ask yourself, are your current financial choices buying you temporary status or permanent freedom? Are you chasing the noise or are you quietly building the signal? Thank you for joining us today. If you haven't already, don't forget to subscribe to Wealth Lab. We'll see you in the next one.